What if I told you there's a powerful financial weapon, kind of hidden in plain sight, one that could, slash your company's tax burden by potentially hundreds of thousands? And not by finding some loophole, but by strategically understanding something every business eventually faces: losses. Today, we're not just defining terms, we're really aiming to equip you with the playbook to turn those setbacks into major tax wins. We're diving deep into the, let's say, intricate world of loss limitations specifically for C corporations. We want to uncover some powerful tax saving strategies that could honestly dramatically impact your bottom line. We're talking net operating losses, NOLs, you'll hear us say, and capital losses, and crucially, how they can be your secret weapon in the, well, often complex landscape of corporate finance.
Absolutely. And our mission today is pretty clear. We're taking the detailed tax guidelines, the rules, the practical examples you've shared with us, and we're going to distill them down into actionable insights. We'll explore the what, the how, and maybe most importantly, the why behind these critical rules. We want to make sure you really grasp the full potential here. Think of these strategies as ways to optimize your company's financial health, like a strategic map, really, for navigating potential tax liabilities.
Yeah, and the material we have in front of us today is incredibly precise. We've got excerpts from a comprehensive guide on calculating these loss limitations for C Corp. It's packed with specific rules, really critical timelines, and even practical examples that we'll walk through, step by step. The goal is to make these complex ideas crystal clear. This isn't just theory. It's hopefully a blueprint for tangible tax savings you can actually implement. Okay, so let's start with the basics. When your balance sheet takes a hit and you're staring down a financial loss, how does the tax code offer, well, a lifeline? For C corporations, it often begins with understanding net operating losses. So let's dissect what an NOL truly is, right at its core.
Right. Fundamentally, a net operating loss, or NOL, happens when a company's allowable business deductions add up to more than its taxable gross income in a specific tax period. It's more than just, say, a bad quarter or a temporary dip in sales. It really signifies that for tax purposes, your business has spent more on legitimate deductible expenses than it actually generated in revenue. From a financial perspective, it's a real economic deficit. But here's the key. This deficit becomes a valuable asset. Because unlike maybe some personal losses that just sort of vanish at year-end, an NOL can often be carried over to other tax years to offset future profits or sometimes even past profits. It's essentially the tax system saying, okay, this business didn't just fail to make a profit, it actually went backward financially, and we'll provide a way to remedy that tax-wise later on.
And what's really striking to me, and you pointed this out, is that C corporations get the same fundamental NOL rules as individuals. That feels like, I don't know, a rare moment of consistency in what can sometimes seem like a really disparate tax code. What's the thinking behind that parity? Why treat them the same here?
That's a great observation, and it really speaks to a core principle of income taxation. The simple recognition that profitability isn't always a neat, linear year-to-year thing. I think about it. Whether you're an individual freelancer with income that fluctuates wildly project to project, or a huge multinational corporation navigating big economic cycles, income and expenses, they rarely balance out perfectly within a strict 12-month accounting window. So the idea of allowing losses from one period to offset income from another, it applies broadly because the underlying economic reality of a loss and the need for some kind of tax relief associated with it is pretty universal. It's really about reflecting a more accurate, sort of longer-term economic picture, not just a isolated yearly snapshot. And that leads us straight into the why. Why does the tax code even allow for NOLs in the first place? The policy rationale is actually incredibly sound, and it serves several vital functions for the broader economy. Just imagine, say, a new tech startup pouring money into R&D. Or maybe a manufacturing company that's completely retooling its factory. These are periods of huge expense, right?
They often result in losses, maybe significant ones. But they're also absolutely crucial for future growth and innovation. Now, if there were no NOL provisions, these businesses would just bear the full brunt of those losses in the current year. And then, maybe a few years later, when they become profitable, they'd get taxed heavily, with absolutely no way to recover taxes based on those necessary past losses. That would be a huge disincentive. So the ability to carry forward, or sometimes carry back, these losses provides this crucial mechanism for businesses to kind of smooth out their income over time. It acknowledges the cyclical nature of profitability. It offers a vital form of tax relief during challenging periods. And this isn't just about, financial aid. It actually encourages resilience. It supports continued investment even when profitability dips temporarily. And it helps prevent a situation where a company might pay, say, significant taxes on a really profitable year, only to incur a massive loss the very next year with no way to connect the two tax-wise. It basically allows the tax system to align more closely with the multi-year economic reality of running a business. It fosters stability, encourages long-term growth, job creation,
Hmm.
rather than penalizing those necessary but sometimes expensive periods of development or just economic downturn. It's actually a powerful incentive for businesses to stay the course through the leaner times.
That makes perfect sense. Yeah, it's about looking at the long game, not just that single snapshot in time and providing that vital safety net. But how exactly does that long game play out on your tax returns, especially when, as you hinted, the rules themselves have been a bit of a moving target over the years? That brings us to the really crucial mechanics of this carry game, where the timing of your loss can dramatically change its value and its utility.
You've absolutely nailed the most critical point here. The rules around carrying back or carrying forward these NOLs, they've shifted significantly over time. It's almost like different generations of tax law layered on top of each other. Understanding these precise dates, when the NOL actually arose, is absolutely fundamental to maximizing its benefit. We essentially have three key periods now, each with its own distinct set of rules. You can almost think of these losses like a unique currency for tax relief. But the rules for when that currency expires, if ever, and crucially how much of it you can spend in any given year, those have changed dramatically. So let's break down these historical shifts, because honestly, the date your loss originated is pretty much everything. Okay, first up, let's look at let's call them vintage NOLs. These are the ones that originated in tax years on or before December 31st, 2017. We'll just call these pre-2018 NOLs. These are, quite frankly, the most generous ones. The rules for these are great. Such losses can be carried forward indefinitely. That means they basically never expire. You could theoretically have an NOL from, say, 2005, and as long as you haven't fully used it up against profits in the intervening years, it's still sitting there on your books, ready to reduce your taxable income today or 10 years from now. And even better, they can offset 100% of a future year's taxable income. There's no limitation on the amount in a given year, other than the income itself. So this means if you had, say, $1 million NOL from 2017, and you finally became profitable enough in 2025 to generate $500,000 in taxable income, you could potentially use that older NOL to wipe out your entire 2025 taxable income down to zero. This offers really profound long-term tax relief. It acts as a very powerful, unconstrained shield against future tax liabilities. It's a significant legacy benefit for companies that happen to have those older losses.
Wow, okay. That is a huge advantage for those older losses. Complete offset, perpetual utility. That's fantastic if you have them. But then, as you said, things started changing, maybe reflecting different economic priorities or legislative goals, I suppose. So what about NOLs that arose after December 31, 2017, but before January 1, 2021? So we're talking about tax years like 2018, 2019, and 2020. That period, I mean, that saw some significant economic turbulence for a lot of businesses, didn't it?
It absolutely did, and this period saw the introduction, or maybe reintroduction in some ways, of a new strategic tool, a carryback provision. This was largely seen as a response to the economic shocks happening then, notably, of course, the COVID-19 pandemic. So for these post-2017, pre-2021 NOLs, the rules allowed them to be carried back 5 years and also carried forward indefinitely. That carryback provision was particularly potent. Why? Because it provided potentially immediate cash flow relief. Imagine you were profitable and paid significant taxes in, say, 2016, 2017, 2018. Then, maybe due to the pandemic or other factors, you incurred a large NOL in 2019 or 2020. Under these specific rules, you could carry that recent NOL back up to 5 years. You could use it to reduce your taxable income in those prior profitable years. And here's the kicker. You could get a refund of taxes you'd already paid in those past years. This was a direct path to liquidity right when many companies needed it most. It was basically giving businesses a quick way to tap into their past tax payments to shore up their current finances during a crisis. For many, it was a direct injection of capital that could have made the difference between, well, survival and collapse.
Right. That immediate refund potential sounds incredibly valuable during a crisis. Okay, so we went from indefinite carry forward for the old losses to a 5-year carryback plus indefinite carry forward for that specific, often tumultuous window of 2018 through 2020. And then the rules shifted again for the most recent losses. What's the deal with NOLs arising in 2021 and beyond? This feels like maybe a more permanent policy shift.
It does seem that way. It is a significant shift, and as you say, likely a more permanent one, at least based on current law. For NOLs arising in tax years 2021 and onwards, they cannot be carried back at all. That carryback provision, that immediate lifeline we just talked about, it was completely removed for these newest losses. However, they can still be carried forward indefinitely. So that part remains. This policy change, well, it seems to reflect a move towards simpler, perhaps more predictable, forward-looking tax planning from the government's perspective. It removes that option for immediate liquidity from a carryback. So businesses can no longer look to past profitable years for immediate tax refunds when they incur a new loss. Instead, they have to exercise more patience. They have to wait until they generate future taxable income to utilize these losses. It really requires a more long-term strategic approach to their tax planning now. It definitely places a greater emphasis on future profitability for loss utilization.
And that brings us to what's truly a fundamental change for these modern NOLs, impacting their utility, maybe even more than just the carryback period, this 80% limitation. When does this critical rule kick in, and how does it fundamentally alter the game for utilizing these newer NOLs?
All right, this is a huge one. This crucial limitation applies specifically to post-2017 NOL carryforwards. So any NOL generated from 2018 onwards, 2018, 2019, 2020, 2021, et cetera, and critically, it started applying in tax year 2021. So when you try to use one of those post-2017 NOLs in 2021 or any subsequent tax year, it falls under this new 80% rule. And this isn't just some minor adjustment. It completely redefines how much tax relief you can actually get in a given year from these losses. Okay, so here's precisely how it works. These particular NOLs, the ones from 2018 onwards, they can only offset 80% of the future year's taxable income. But there's a really critical nuance here, kind of a stacking order, if you will. This 80% calculation, it happens after you've first deducted any of those older pre-2018 NOL carryforwards you might still have. So if a company is fortunate enough to have those vintage pre-2018 NOLs, those get used first. And remember, they can reduce income entirely down to zero potentially because they don't have this limitation.
Then, if there's still taxable income remaining after using those old NOLs, that's when the 80% limitation applies to your post-2017 NOLs against the remaining income. What this means practically is you can never fully zero out your taxable income with these newer NOLs if you have a significant amount of profit in that future year. You'll almost always be left with at least 20% of your taxable income being subject to tax in that year. It effectively stretches the utility of the NOL out over more years, sometimes quite significantly. It really transforms these newer NOLs from being a potential tax elimination tool into more of a tax mitigation tool.
Wow, okay. That dramatically reshapes the tax planning landscape, doesn't it? If you fundamentally can't completely wipe out your taxable income with these newer losses, it must require a different approach to budgeting, cash flow forecasting, everything. What are the broader implications of this 80% limitation for corporate tax strategy?
Absolutely. The implications are huge. This 80% limitation demands a far more strategic and frankly more patient approach to using your NOLs. It's no longer just a straightforward one-to-one offset for these newer losses. It means your tax savings from a specific NOL will likely be realized over a longer period. For example, like you said, if you have a $1 million NOL from, say, 2021, and you generate $1 million in taxable income in 2025, you can only use $800,000 of that NOL, 80% of $1. You still pay tax on the remaining $200,000 of income. That leftover $200,000 of your NOL then carries forward to the next year. So this compels businesses to anticipate stretching the benefit out over more years than they might have previously. It also requires much more sophisticated forecasting, as you mentioned. Companies really need to project their future income streams more carefully to optimize when and how much of their NOLs they'll likely use each year under this limitation. It might even influence operational decisions. For instance, a company might consider accelerating some income or maybe deferring certain deductions in specific years to try and maximize NOL utilization when the 80% limit is less restrictive for them, or maybe when future income is projected to be substantially higher, making the NOL more valuable then. And for things like M&A activity, understanding this 80% limitation is absolutely crucial for accurately valuing target companies that have significant NOLs. It fundamentally changes how businesses need to manage their loss positions. It really moves it from the simple offset calculation to a much more complex game of optimization over time.
Okay, speaking of strategy and choices, you mentioned earlier that a taxpayer can sometimes elect not to carry back an NOL, even when a carryback is allowed under the rules for that specific loss year, like those 2018-2020 NOLs. Instead, they can choose to only carry it forward. That seems, well, counterintuitive on the surface. Why would a C corporation intentionally forego a potential immediate refund, especially when cash flow is often king?
That's an astute question, and it really highlights the strategic flexibility that's sometimes built into these rules, even when they seem restrictive. There are indeed several compelling scenarios where a corporation might deliberately choose to forego that carryback and only carry the NOL forward. One of the most common reasons is simply in anticipation of significantly higher future tax rates. If a company projects that tax rates in, say, 3 to 5 years are going to be much higher than the rates that applied in the past 5 years, the years they could carry back to, it might be far more beneficial from a total tax savings perspective to save that NOL. By carrying it forward, they can offset income that would otherwise be taxed at a higher future rate, maximizing the ultimate tax savings per dollar of NOL. It's kind of like holding onto a valuable coupon to use when the price of the item you want to buy is expected to be highest. Another very practical consideration can just be administrative simplicity, amending prior year tax returns to claim a carryback. That can be a surprisingly complex and time-consuming process, especially for larger organizations or maybe those with more limited accounting resources.
For some, the administrative burden, the professional fees, the time involved in amending multiple past returns might actually outweigh the benefit of an immediate, but perhaps relatively modest refund. And lastly, there might be some niche situations where carrying back an NOL could unintentionally trigger other negative tax consequences in those prior years, maybe related to credits or other limitations. Or perhaps the past years just had very little taxable income anyway, making the potential carryback refund amount negligible. So, while immediate cash flows offer a top priority, factors like future tax rate projections, administrative efficiency, or avoiding unforeseen tax complications in prior years can certainly influence this strategic decision. It really depends on a company's unique financial outlook, their projections, and maybe even their tolerance for administrative complexity.
Fascinating. It truly is multi-layered, isn't it? Okay, let's drill down into some specific nuances in how a corporate NOL is actually calculated. My eye caught a key exclusion from the source material. No charitable contribution deduction is allowed when calculating the NOL itself. Why is that specific deduction treated differently from, say, salaries or rent in this context?
Yeah, this is a subtle but important distinction, and it reflects the specific purpose behind the NOL calculation itself. When you're determining an NOL, the tax code is really trying to identify the true operating deficit of the business, basically. The loss resulting from its core revenue-generating activities and the direct expenses incurred to produce that revenue. Charitable contributions, while certainly deductible for general income tax purposes and absolutely valuable socially, are generally considered more discretionary expenses from a purely operational standpoint. They aren't typically directly tied to the fundamental process of earning business income in the same way that, for instance, cost of goods sold, employee salaries, or facility rent clearly are. So, by excluding them specifically from the NOL calculation, the tax code aims to ensure that the NOL accurately reflects the core operational loss. It distinguishes that core loss from other deductions that might be taken for, say, philanthropic reasons or other non-essential purposes, rather than direct business necessity. It helps focus the NOL on the true financial health of the core operations.
Okay, that makes sense. And there's another interesting specific rule you highlighted around the dividends received deduction, the DRD. Apparently, the normal taxable income limitation that usually applies to that deduction doesn't apply if, after taking the full dividends received deduction, the corporation actually ends up with an NOL for the year. Could you maybe first quickly clarify what the dividends received deduction is, and then explain why this specific carve-out or exception exists?
Certainly. The dividends received deduction, or DRD, as it's often called, is a really crucial provision in corporate tax law. It's designed primarily to prevent what's known as triple taxation of corporate earnings. Think about it. Without the DRD, if Corporation A owns stock in Corporation B and Corporation B pays dividends out of its after-tax earnings, those earnings would first be taxed at Corporation B's level. Then they could be taxed again as dividend income received by Corporation A. And then potentially a third time when Corporation A distributes its own earnings, including those dividends, to its individual shareholders. That's excessive. So the DRD allows a receiving corporation, like Corp A, to deduct a certain percentage, typically it's 50%, 65%, or even 100% depending on the level of ownership of the dividends it receives from another domestic corporation, like Corp V. This helps prevent corporate earnings from being taxed excessively as they flow through multiple corporate entities before reaching individual shareholders. Now, regarding that specific carve-out you mentioned, normally, yes, this DRD is limited.
It's usually capped at a percentage of the corporation's taxable income, calculated before considering the DRD itself and some other deductions. However, the rule explicitly states that this income limitation does not apply if, by taking the full unlimited dividends received deduction, the corporation either creates an NOL for the year or increases an existing NOL. This is a specific policy decision. It's designed to avoid penalizing corporations that are already in a loss position or are pushed into one by claiming this legitimate deduction. It basically ensures that corporations receive the full intended benefit of the DRD, irrespective of their overall profitability in that specific year, especially when they're already experiencing a net operating loss. It prevents the tax system from artificially limiting a valid deduction, precisely when a company is struggling financially. It makes sure intercorporate investment isn't disproportionately taxed in loss situations. And another crucial point, just to be perfectly clear, when calculating a current year NOL, you absolutely cannot include an NOL deduction that comes from a NOL carryover from another year. This is really a foundational principle of the NOL calculation. You are trying to determine the net operating loss for this specific tax year only. That's the goal, including a loss that actually originated in a prior year and is merely being carried over into the current year. That would create a kind of compounding or double counting effect. The same economic loss could potentially be used repeatedly in different NOL calculations across multiple tax periods. So the tax code is very clear on this. Each year's NOL is a distinct calculation based on that year's specific income and expenses resulting in a deficit. It prevents the layering or mixing of historical losses into a fresh annual calculation.
Okay, got it. Now, this last nuance you brought up earlier sounds a bit counterintuitive, but you stressed it's crucial for precision. A corporation may deduct a capital loss carryover from a current year capital gain when calculating an NOL. Yet, it cannot deduct a capital loss carryback against a net capital gain when determining a current year NOL. That distinction between a carryover and a carryback in this specific context sounds like a potential trip-up. Can you really clarify that for us?
It absolutely is a point of precision that, many can overlook, and it really highlights the strict boundaries the tax code draws around how different types of losses interact, especially regarding timing. Let's break that down carefully.
All right.
Okay, first part. When you have an existing capital loss from a prior year that is being carried forward into the current tax year, and you also happen to have a capital gain in this current year, you can, and in fact should, use that capital loss carryover to offset the current year's capital gain. The standard procedure for capital gains and losses. Now, when that offset occurs, what does it do? It effectively reduces your overall gross income for the current year because the capital gain component of that gross income is now smaller. This reduction in gross income, in turn, can then increase the amount of your current year's net operating loss. The mechanism here is indirect, as we discussed before. By lowering that initial gross income figure, your operating expenses, which remain constant, are now subtracted from a smaller positive number. This results in a larger deficit, hence a bigger NOL. Think of it like lowering one side of a seesaw, gross income. The other side, expenses driving the loss, appears to go down even further relative to the starting point. However, and here's the contrast, the rule explicitly states you cannot use a capital loss that you anticipate carrying back from the current year to a prior year to somehow retroactively reduce a current year's net capital gain when you're figuring out the current year's NOL. Why? Because a carryback is fundamentally a future action. It's about taking a loss determined in the current year and applying it back to amend the past year's return. You're trying to determine the current year's NOL based purely on current economic activity and existing carryovers that have already landed in this year. You're not supposed to factor in potential future carryback applications. The distinction really boils down to timing and the direction of the loss flow. A carryover is an existing deduction flowing into the current year's calculation. A carryback is a potential future reapplication out of the current year to the past. This rule keeps the current year's NOL calculation clean, based purely on its own specific income and deductions for this year, while still allowing the strategic benefit of prior capital losses, carryovers, to indirectly influence the current NOL calculation by reducing current gross income. It prevents blending future possibilities into a present-day calculation.
Okay, wow. This is all incredibly detailed, and honestly, the best way to make these rules truly concrete is probably to walk through a practical example. Let's bring in Reichel Corp. From our source material. So Reichel Corp, the setup is, it's a calendar year C corporation, started doing business in 2021. And unfortunately for them, in its very first year, 2021, it incurred a significant net operating loss of $100,000. Not exactly the ideal start for a new venture, right? But it's precisely the kind of scenario these NOL rules are designed to help with. So now let's look at how this $100,000 loss plays out in the subsequent year, 2022. In 2022, Reichel Corp's taxable income before considering any NOL utilization was $90,000. So how does that $100,000 NOL from 2021 get applied here, given all the complex rules we've just discussed, especially that 80% limit?
Okay, yeah, this is a perfect test case for that 80% limitation we spent time on. Why? Because the NOL originated in 2021, which falls into both the post-2017 and the 2021 and beyond categories. And crucially, it's being carried forward to 2022, which is a post-2020 year where the 80% limitation applies.
Yeah.
So Reichel Corp has $90,000 in taxable income for 2022. According to the rule, they can only offset 80% of that income with their post-2017 NOL. So we need to calculate $90,000 multiplied by 80%. That gives us $72,000. This $72,000 is the maximum amount of that $100,000 NOL that Reichel Corp is allowed to utilize in 2022. It immediately prevents them from using the full $90,000 needed to zero out income.
Right. So after applying that allowable $72,000 NOL, Reichel Corp's actual taxable income for 2022 would be $18,000. That's the original $90,000 income minus the $72,000 NOL they could use. So it significantly reduces their tax burden, clearly, which is great, but importantly, it doesn't wipe it out completely. They're still left with the taxable amount because of that limitation.
Precisely. And this is a really critical point that highlights the practical impact of those temporal rules we discussed earlier when the loss originated matters hugely. Just consider this hypothetical for a second. If this exact same $100,000 NOL had originated prior to 2018, let's say it was from 2017 instead of 2021, then the 80% limitation would not apply at all to its carryforward. In that very different scenario, Reichel Corp could have used the full $90,000 of the NOL needed to reduce its 2022 taxable income all the way down to zero. That stark contrast, $18,000 taxable income versus $0 taxable income, purely based on the origination date of the loss. It truly underscores how crucial knowing the vintage of your NOL is for predicting its future utility and the amount of tax relief it can provide in any given year. It really is the difference between having a full shield against income and only a partial one for these newer losses.
That's incredibly insightful. Okay, so back to the actual Reichel Corp example. They used $72,000 of their $100,000 NOL in 2022, so they still have some left over, right? How much do they have remaining, and how does it play out in the following year, 2023? Do they face that same 80% limitation again?
They do, yes, because the NOL still originates from 2021. So let's track it. They started with a $100,000 NOL from 2021. They utilized $72,000 of it in 2022. That leaves them with a remaining NOL carry forward of $28,000, $100,000 minus $72,000 going into 2023. Now, the example states that for 2023, Reichel Corp's taxable income before any NOL utilization was $50,000. Okay, so since the NOL still originates from 2021, that 80% limitation applies again for the 2023 tax year. We need to calculate 80% of the 2023 taxable income to see the maximum NOL they could use. So $50,000 multiplied by 80% equals $40,000. This $40,000 represents the NOL ceiling for them in 2023.
Ah, okay. And since their actual remaining NOL is only $28,000, and that amount is less than the $40,000 limitation or ceiling,
Yeah.
they can just use the full remaining $28,000 this year. It doesn't get stretched further or limited beyond its actual remaining balance in this case.
Exactly right, because the remaining NOL, $28,000, does not exceed the calculated 80% threshold, $40,000 the current year's income. The entire $28,000 balance can be utilized in 2023. So their final taxable income for 2023 is calculated as their pre-NOL income of $50,000 minus the full remaining NOL of $28,000. That equals $22,000 in taxable income for 2023.
In this Reichel Corp example, walking through it year by year, it really clearly shows how understanding these specific rules, the timing, the 80% limit, how it carries forward, allowed this company to significantly reduce its tax burden over 2 subsequent years. It's a direct, tangible impact of having a well-executed NOL strategy, even with that 80% limitation now in play for newer losses. It really means that while the game has changed significantly, the power of NOLs, if managed correctly, remains immense. Okay, great. Now let's pivot slightly to talk about capital losses. These are, as you mentioned, a distinct category, but as we hinted earlier, often connected tax-saving mechanism. The first crucial distinction we need to make right off the bat is between how corporations and individuals get to treat capital losses. What's the immediate, most significant difference our listeners absolutely need to be aware of?
Yeah, the immediate and really significant difference is this. C corporations do not get that $3,000 deduction against ordinary income for net capital losses that individual taxpayers are typically allowed. You know how for individuals, if your capital losses exceed your capital gains in a year, you can usually deduct up to $3,000 of that excess loss against your ordinary income like your salary or maybe small business profits. Corporations get zero of that. They cannot deduct any net capital loss against their ordinary operating income. This fundamental structural difference exists, well, partly because corporations are generally assumed to be engaged in ongoing business activities. Capital assets and their sale are often more closely tied to the business's operational or investment framework. So distinct rules apply to ensure that corporate capital losses are primarily offset against corporate capital gains, which themselves are often tied to business investment or divestment activities, rather than being used to shield regular operating income from tax. And this leads directly to the really strict, unwavering rule for corporations regarding capital losses. They can only use capital losses to offset capital gains.
Period. This is a fundamental constraint that honestly cannot be overstated. It's very different from net operating losses, which, as we saw, can generally offset a broad range of ordinary income, subject to limitations like the 80% rule. Capital losses for corporations are much, much more targeted in their application. So if a corporation experiences a large capital loss, maybe from selling off a piece of equipment or some subsidiary stock at a loss,
but it has no capital gains in the relevant time periods, either the carryback or carry forward years, that capital loss cannot be used to reduce its ordinary business income from its main operations, like sales or services. It's strictly solely applied against capital gains only. This means their utilization is entirely dependent on a company having capital gains from its investment and investment activities, and crucially, on the timing of those transactions relative to the losses. The bottom line is, if you're a C Corp with capital losses, you need capital gains somewhere in the allowed time frame to actually realize their tax benefit.
Right. So if you're a C corporation, you're constantly looking for that capital gain to pair up with your capital loss. It's like needing the perfect match on your tax return to get any value. Okay, given this strict limitation only gains offset losses, how long do corporations actually get to carry over these capital losses? What are the specific carryback and carry forward periods businesses need to know?
Yeah, unlike the indefinite carry forward for most NOLs now, corporate net capital losses have very specific and relatively shorter carryback and carry forward periods. The rule is, they are carried back 3 years first. Then, if not fully utilized in those 3 prior years, they are carried forward for 5 years. So this means a corporation basically has a limited 8-year window in total, 3 years looking back, 5 years looking forward from the year of the loss to fully utilize its capital losses against capital gains. If sufficient capital gains don't materialize within that 8-year time frame, the capital losses expire completely unused. They become functionally worthless for tax purposes after that point. This really underscores the importance for corporations of actively managing their capital asset portfolio and maybe strategically timing asset sales, if possible, specifically to generate gains that can absorb existing or anticipated capital losses before they expire. Oh, and there's an important technical detail here regarding the nature of the loss when it's carried over. When these corporate capital losses are carried back or carried forward, they are specifically treated as short-term capital losses, regardless of whether they were originally short-term or long-term when realized. This nuance is actually quite critical because, in the hierarchy of applying losses against gains, short-term capital losses are generally applied first against short-term capital gains, and then, if any loss remains, against long-term capital gains. So this reclassification to short-term ensures a specific, consistent order of application against future or past gains. This can impact the overall tax calculation, especially if the company has a mix of short-term and long-term capital gains in those other years.
Okay, understood. And just to really hammer this home, whether they're carried back to those 3 prior years or carried forward for those 5 subsequent years, these capital losses are applied only against capital gains. It remains a very restrictive, very specific application.
Precisely. That's the unwavering rule. This strict targeted application means corporations absolutely must have sufficient capital gains pop up somewhere in that relevant 3-year carryback or 5-year carry-forward period to actually get the benefit of their capital losses.
Yep.
If those gains just don't materialize within that relatively narrow window, the capital losses could expire unused, vanishing into thin air from a tax perspective. It really emphasizes, again, the critical need for strategic capital asset management. Maybe timing sales, maybe adjusting the portfolio, specifically looking for opportunities to generate gains that can absorb these time-limited losses. It often needs to be a proactive rather than reactive area of tax planning.
Okay, now let's get to the really fascinating part, the interplay between these capital losses and NOLs. We're going to use the Lane Corps example from our sources here. This is where it gets, as you said, really interesting and maybe a bit counterintuitive, because it shows how a capital loss can actually indirectly influence and even amplify a net operating loss. This feels like a critical insight for truly optimizing your overall tax position. So let's set the scene for Lane Corp. The numbers are, they have gross income of $400,000. Crucially, that $400 K figure includes a $150,000 capital gain within it. They also have operating expenses totally separate from that, amounting to $500,000. And importantly, Lane Corp has an unexpired capital loss carryover of $20,000 brought forward from a prior year. How does all of this fit together? How do we figure out their current year NOL? This feels like a puzzle with several moving pieces that need to connect just right.
It is indeed a puzzle, and it perfectly illustrates that intricate dance between different loss types and income types. The initial, absolutely crucial first step is to deal with that unexpired capital loss carryover. Lane Corp has a current year capital gain of $150,000 baked into its gross income, and it has this $20,000 capital loss carryover from a prior year. The tax rules mandate that the capital loss carryover must first be used to offset that current year capital gain.
It's the first thing you do. So the $150,000 capital gain component of their income is immediately reduced by that $20,000 capital loss carryover.
Okay, which effectively reduces the taxable portion of that capital gain, right?
Right.
And then as a kind of downstream effect, that lowers the total gross income figure that we need to consider for the subsequent NOL calculation.
This reduction seems like the key domino to fall, isn't it? It's absolutely the key domino, yes. After deducting that $20,000 capital loss carryover against the capital gain component, Lane Court's gross income, specifically for the purpose of determining the current year's NOL, is no longer the initial $400,000. It's now effectively $380,000. That's the $400,000 original gross income minus the $20,000 capital loss offset that just happened. This adjustment to the gross income figure is the foundational step. It sets the stage for the next part of the calculation, the NOL itself.
Okay, got it. So with that newly adjusted gross income number of $380,000, how do we then calculate the current year NOL, given that their operating expenses were $500,000?
Right. Now that we have the correct adjusted gross income base, it becomes a straightforward calculation for the NOL itself. You simply take that adjusted gross income of $380,000 and you subtract the operating expenses of $500,000. $380,000 minus $500,000 directly results in the current year, net operating loss of $120,000.
Okay, and here's where it gets really interesting. Pulling that powerful insight directly from our source material, it explicitly states, effectively, the capital loss carryover increased the current year NOL. Now, that sounds completely counterintuitive at first hearing because we just spent time establishing that capital losses can only offset capital gains, not ordinary income or NOLs directly. So how on earth did that $20,000 capital loss carryover manage to make that NOL $20,000 larger than it otherwise would have been? This feels like some kind of tax magic trick.
Haha, it does feel like magic. But it's actually a brilliant piece of indirect tax mechanics that savvy tax strategists definitely leverage. Let's unpack exactly how that happened step by step. The $20,000 capital loss carryover didn't directly become part of the $120,000 NOL. That's not what happened. Instead, by being utilized against the $150,000 capital gain first, it reduced Lane Court's total gross income figure that the operating expenses were then subtracted from. Think of it maybe like this. Your operating expenses, $500,000, are like a fixed amount you're spending to dig a hole, represented the loss. If you started digging from higher ground, meaning a larger gross income base of $400,000, your $500,000 in digging expenses would result in a $100,000 hole below ground level, an NOL of 100 cal. But by first using that $20,000 capital loss carryover to reduce your starting ground level, lowering gross income from $400,000 down to $380,000, those same $500,000 digging expenses suddenly make the hole much deeper relative to ground level zero. Instead of subtracting $500,000 from $400,000, giving a $100 K loss, you're now subtracting $500,000 from only $380,000, resulting in a deeper hole and NOL of $120,000.
So the capital loss carryover, simply by reducing the base income figure against which the operating expenses are measured, effectively amplify the net deficit for the year. It produced a bigger net operating loss. If Lane Corp hadn't had that $20,000 capital loss carryover available to offset part of its capital gain, its gross income for NOL calculation purposes would have remained at the full $400,000. Subtracting the $500,000 expenses would have led to an NOL of only the $500,000. That $20,000 difference in the final NOL is the direct, albeit indirect, result of the capital loss carryover impacting the gross income first. It's a really powerful, somewhat subtle interaction that, many might overlook, but it's absolutely critical for truly holistic tax planning.
That definitely demonstrates a critical indirect connection between capital losses and NOLs that tax planners and business owners, frankly, absolutely must understand. It really means you can't just view these two types of losses in completely separate silos. They can significantly influence each other's calculations and ultimate value.
Precisely. Understanding this intricate connection is exactly what allows for more holistic and therefore truly effective tax planning strategies for C corporations. It means you can't just look at NOLs over here and capital losses over there as totally separate things. You really have to consider how these different types of losses can work in concert, whether directly offsetting certain income or indirectly influencing other loss calculations like we saw with Lane Corp, to minimize the overall taxable income and maximize your tax efficiencies. This integrated, comprehensive approach is what truly optimizes a company's tax position. It ensures you're leveraging every available avenue for tax relief. It really moves tax planning beyond mere compliance into the realm of strategic financial advantage.
Okay, so let's try and wrap this up. What does all this complexity, all these rules and interactions, what does it all mean for you, the learner, maybe the business leader listening in? We've clearly seen that managing net operating losses and capital losses isn't just about, adhering to IRS regulations. It's actually a powerful strategic lever for C corporations, a lever that can significantly reduce tax liabilities and ultimately optimize financial performance. These aren't just arcane rules, they represent pathways to substantial real dollar savings.
Indeed. I think the key takeaways are understanding those specific carryback and carry forward rules, especially nailing down that critical 80% limitation for recent NOLs, is absolutely vital for any forward-looking tax planning today. That limitation really changes how you utilize newer losses. And crucially, remember that capital losses, while distinct in their direct application only against capital gains, can indirectly yet powerfully influence your overall NOL position, just like we saw clearly demonstrated with the Lane Corp example. These are not just isolated tax concepts floating out there. They are truly interconnected tools in a comprehensive tax strategy. And using them effectively can translate directly into improved cash flow and a healthier bottom line.
Yeah, and for you, the learner listening to this, these aren't just abstract rules on a page or numbers in an example. These are potential blueprints for tangible tax savings and just smarter financial management overall. Hopefully, this deep dive has equipped you with the knowledge to ask more informed, more precise questions of your financial team or your tax advisors. Maybe it helps you work more effectively with them and ultimately allows you to contribute more significantly to optimizing your company's bottom line, because the ability to identify and properly leverage these often complex tax-saving mechanisms can translate directly into substantial financial benefits and ultimately a stronger balance sheet for the business.
Which really raises an important question, I think, for every business leader, every finance professional out there listening. In this world of constantly evolving tax codes, dynamic business cycles, how actively are you in your organization identifying and leveraging every available loss mitigation strategy? Not just the obvious ones, but the nuanced interactions too. What potential tax-saving opportunities might you be missing, perhaps simply because you haven't performed a really thorough deep dive into the specifics of your own company's financial patterns and how these intricate, sometimes counterintuitive tax rules actually apply to you? It's not just about knowing the rules exist, but about how actively and strategically you apply that knowledge to your specific situation.
Definitely something to mull over as you continue to navigate the often intricate landscape of corporate finance and taxation. We really hope this deep dive has given you a significant head start on that journey, maybe providing you with a clearer roadmap to potentially turn past or current losses into future long-term strategic gains for your company.